There's a lot of confusion surrounding paying yourself as the owner of a small business. Now, there are a handful of entity structures that you can operate under. A single member LLC, which is a pass-through, where all the income gets reported on your personal tax return. No W-2 has to get filed for this. An S corporation, you have two components. You have a W-2 component, and you also have K-1 component that is reflected on your personal tax return. You have a partnership. A partner usually gets a share of the agreed upon profit and loss of the company, and that's also on the K-1 form. You take it, you file your tax return, you pay tax on that number. One of the most confusing aspects of these three structures is the taxation of the income. Now, for these three structures, regardless of whether you take the money out of the business or not, you are going to be taxed. The last thing I want to talk about is a C Corp. There are two ways of paying yourself. One, through a W-2, and then whatever's left over in the C corporation, if you don't pull out everything that's in the corporation at the end of the year, you actually have net income, the corporation is going to have to pay tax on it. And then in order to get that money, you're going to take it out as a dividend and you're going to get taxed on it again. That's why we say there's a double taxation on corporations.